In the first quarter of this year, official US growth numbers came in much lower than expected at just 0.7%. After a two-day meeting, the Federal Open Market Committee says it expects the US economy to perform better than it did in the first 3 months, pointing to recent strength in employment, consumer spending and business investments.
So we've got an economy in terms of unemployment and inflation which is essentially fully normalized. And meanwhile, interest rate policy we've just discussed is far from normalized, negative in real terms, even in nominal terms, very low by any historical standards.
After raising the federal funds rate at its last meeting in March to a range of between 0.75% and 1%, the Fed's holding off on any further increases for now. President Trump wants to slash corporate taxes by more than half and boost infrastructure spending. Both could stimulate the economy, but his proposals could get stalled in Congress. So for now, it's wait and see.
I don't think the Fed wants to be overly sensitive to or hyper-reactive to events that move markets, for example, on a day-to-day, week-to-week, or even a month-to-month basis. So the Fed's trying to, I think, look through, with a 2 or 3 year forecast horizon, what the probable outcomes are on all these dimensions.
Those dimensions include changing aspects of the global economy that might impact the US, including Brexit's threat to European unity. In March, members of the Federal Open Market Committee predicted 2 further interest rate rises this year if current conditions continue. Daniel Ryntjes, CGTN, Washington.